you can have the money. The credit score, the pre-approval, everything lined up. And a co-op board can still say no, and they don't even have to tell you why. If you're buying in New York, this is the part nobody prepares you for. So let's actually walk through it. I'm Brian Scott Cohen, your mortgage guy, and I put together board packages and financing for co-op buyers every single day. Let's get into it. Here's the thing most buyers don't realize going in. When you buy a condo, you're buying real property, plain and simple. A co-op is different. When you buy a co-op, you're actually buying shares in a corporation, and that corporation owns the building. Those shares come with a lease on your specific unit called a proprietary lease. That's why the board gets a say in who moves in. They're not just approving a buyer. Technically, they're approving a new shareholder in their company. That's the whole reason this process exists, and it's why buying a co-op is such a different experience than buying a house or a condo. Before you ever sit in a room with anyone, you're submitting what's called a board package. This is the paperwork that does the talking for you, and most buildings want it thorough. We're talking 2 years of tax returns, your bank and investment statements, employment verification, reference letters, and a personal statement explaining why you want to live in that specific building. Some buildings want 3 copies bound a very specific way. It sounds excessive because it is. Your managing agent will tell you exactly what that board wants, and skipping even a small detail is one of the most common reasons a package gets sent back before anyone's even reviewed it. This is where I come in, and it's where a lot of buyers get caught off guard. Co-op boards care about 2 numbers on top of whatever your lender already approved you for. The first is post-closing liquidity, meaning how much money you have left over after the down payment and closing costs. A lot of buildings want to see 2 full years of mortgage and maintenance payments sitting in reserve completely untouched. That's not a nice to have, that's often a hard requirement. The second is your debt to income ratio, or DTI for short. That's how much of your monthly income goes toward debt. And here's the catch. Boards frequently hold you to a stricter number than your lender does. Your bank might approve you at a debt to income ratio of 43%. The board's finance committee might want to see something closer to 25 or 30%, especially in stricter buildings. So getting pre-approved isn't the finish line in the co-op purchase. It's really just the starting point. If your paperwork clears, most boards want to meet you in person. This is usually the part people dread the most, and honestly, most of that fear is overblown if you walk in prepared. A couple of real rules here. Boards legally cannot ask you about things like your family plans, your religion, your national origin, or anything else covered under fair housing law. If you get an odd question like that, you're allowed to redirect it or just decline to answer. What they're actually trying to figure out is much simpler. Are you going to be a good neighbor? Can you clearly explain your own finances? Do you understand what you're taking on? Buildings reject people far more often for vague, shaky answers about money than for anything about their personality. So what actually gets people rejected? From what I see most often, it's insufficient post-closing liquidity. A debt-to-income ratio that's fine for a lender, but too high for that building's comfort level. An incomplete or inconsistent board package. Red flags in someone's employment history that never got explained up front. And in rare cases, personal fit, but that's far less common than people assume, and it's usually not the real reason, even when a building won't tell you what is. So what actually moves the needle? 3 things. First, know the building's specific financial requirements before you even bid. Your broker or I can usually dig that up in advance. Second, build in cushion. If you're sitting right at the liquidity minimum, that's a weak application, even if it technically qualifies on paper. Third, get your board package right the first time. A clean, complete package submitted once is worth a lot more than a fast, sloppy one you end up having to resubmit. If you're thinking about buying a co-op and you're not sure whether you'll qualify for the building you want, reach out before you make an offer, not after. All my contact info is in the description below. And if this was helpful, subscribe and follow me on social so you don't miss what's next. Thanks for watching. I'll see you in the next one.